Next week, no class. Week 15, we will finish up the chapter 16 and 17, and the exam will be due. Everything's basically due by the 12th, which is the last day of class. And as far as week 16 is concerned, I'm going to leave that open. A Zoom meeting. I'll still be here, but it'll be kind of for those people that want extra help with stuff. All right, so this is what we're going to cover today. I think we can get through it. None of these are huge, but the classical sampling, final case, and then completing the audit, which is chapter 16. Chapter 17 is a little bit bigger chapter. We'll put that off until week 15, but that should be it. The sampling exam, I'll send it out tomorrow. I might get it out tonight, we'll see. But it's not hard. It won't be too bad. Any questions? Anybody? One more time? Yeah. It would be on 11th. Yes. Well, that's the 15th. That's the 15th session. I think that's the North 15th class, right? There's actually one more, but I'm gonna leave that for kind of open. So if you don't need to come, if you have everything in, basically. But yeah, the 4th is that's this week, 15th. Let me make sure I'm not lying to you. So the 14, the 13, the 14, this is 15, yeah.
Okay. Our course is accelerated for this whole day.
Yeah, it is. Yeah, so this is it starts out at week 9. I mean it's so yeah, when I say that, I mean this it's really week 8. So 15 would be, you gotta subtract 8 from these. So your our 15 would be your week 7. Yeah. Yeah, I got other classes that are going at the same time. If I do those 1 through, if I do this class 1 through 8, then I know we'll mess with them. Okay, so this is so make sure, so next week we won't have a class, there'll be no class. And that's kind of why I'm getting this the final case out. I was going to do it week 9 or I'm sorry, I'm confused. Week 15 / week 7, but I'm going to put it out now so you have a little more time on it. Okay, let's go ahead and get started. Sampling. We're going to do classical sampling, and there is other sampling, but we're going to do classical sampling. This is kind of what you do to determine whether you're going to, whether the financial statements are misstated, materially misstated. And we do, there's, I don't know. Like this. I'm on board here. So why do we do sampling? We do sampling for 2 reasons. First of all, it's more efficient oftentimes than testing every single item. Second of all, there's some things you cannot test. You can't get the entire population of it. So something like this, we'll take a sample of a few of the total population, and then sorry. And then we project it over the total population. And that's not just for auditing. I mean, if anything, if you come out with a new drug, you test it on a few people, and you say, okay, it works this well on this many people, so it'll work on 42% of total population, whatever. So you're going to project it for the entire population. And we do this in auditing because it's much more efficient most of the time, but also sometimes it is impossible. you take if you take a company like Walmart, if you were to do a year-end, um, dangerous. If you're a company like it'd be completely impossible to do a complete year-end inventory of Walmart. There aren't enough auditors in the world, to do that, to go into every store and to do a 100% audit would be of every item in their inventory would be completely impossible. So you have to do a sample and then predict it over the population. And again, this is for anything. If you want to know how many pounds of ducks there are in a lake, you go scoop up some ducks, weigh them, and use that as your guide to see, okay, there's each duck weighs out, what duck weighs 4 pounds. And you say, okay, we estimate that there's whatever, 1,200 of them, and you can estimate how much, how many ducks there are. So it's not just for auditing, it's for anything. All right. So let's go ahead. All right. So, and by the way, oftentimes you can get pretty accurate even with a smaller sample. That you'd be surprised, like a sample of about 500 will almost estimate anything. But you can get fairly accurate, and it's not just for your own, ease of work. It's also that you're saving money for the client, because basically whatever you charge, it goes to the client plus whatever profit you make on it. So you're also working with the client's money, and you have a duty to that too. Okay, so here is our first one. We have a book value of $1 million. Number of sales, 25,000. And we took an audit sample of 1,000. First thing we got to do is find the average. Just divide them. Oops. Hey, my numbers isn't unlocked. There's $7.80. Let me do something here. Okay. So this is our audit amount. That should be a comma, not a period. The book value of those, well, we check the book value, and it is $42. Okay, so here's our sample size of 1,000. The total population is 25,000. So we're taking 1,000 of them. And we have the average audit sample is 3780. And the average book value is okay. So now what we're going to do is project this over the entire population. So we're going to take this sample and we are going to project it over the entire population to get an idea of what the total population should be. Okay. So let's take a look here. So we have our audit average times the population. So mean per unit is one way of doing it. And mean per unit is a good way if you have no idea if you didn't have any idea what the client had for a dollar amount in there, it would be kind of strange for auditing, but the duck example I gave you would be a good one. You don't know exactly what the ducks are until you go figure them out and no one else, and you're not comparing it to anything, but you're only going to use the mean just says average. Now, which average are you going to use? The audit, the amount that you checked to see what it was, or the book value, what the client gave? Which one is probably the better of the two? Which one are you more confident in? The one you did or the one that someone handed you? Sorry?
The other,
Yeah, this one is more persuasive. Do you smell persuasive? I don't know. Well, it'll tell me. Yeah, anything you do yourself is more persuasive than something someone else hands you. We checked this one. We know that these are 3780. Whatever the client gave us, they gave us, but this one's more persuasive. So when we do this mean per unit, we're using our average, the audit average. Times the total population. So we're going to say that everything in this population, every item in the population, every item in the population should be at what we came up with for our average. So how many items are there in the population?
that which is price.
Yeah. So there's 25,000 in the population. So we're going to say that every one of those should be at what we think, at what we came up with for our average. And that's going to be some number that I don't know yet. $945,000. And so this will be our the projected value turquoise. Yeah. Oh, thank you. So this is our projected value. So what we've done is taken our audit average and projected it over the entire population. And we're saying the projected value is 945,000. So that's our best, for using this method, that's our best estimate of what that is. Okay, now, let's go down here. So the total book value is $1 million. Make that yellow. Our projected value is, oops. I'm gonna do a very good job of our projected value is 945,000. And so this will be our projected misstatement. 55,000? Nope. The question is this an overstatement or an understatement? Yeah, it's an overstatement. They're saying it's worth more than it really is. So this 55, so it's a positive. This is a positive 55,000. I'm going to plus in front of there. Yeah, so that would be an overstatement. They're saying it's worth a million. We're saying it's worth 945. So they are overstating it by 55,000. Now, whether that is material or not will depend on, auditor judgment. And they don't really, they don't test that on CPAs as well. Say, is this material or not? Because it is a judgment. But they can ask you what would be the projected misstatement, and that would be, you should all get the same number for that. Whether it's material or not is a judgment. Okay, so that is mean per unit, and that is basically just taking our average and saying, this is what we think it should be. This is what we came up with. And this is what we think it should be based on solely on our stuff, so we took our sample, we projected it using mean per unit to give total population of 945,000. Okay, there are other ways of projecting it that we're going to do next. Ratio estimation. And ratio estimation is, it basically says that large things will have large errors and small things will have small errors. So there's a ratio involved in it. So large things, large errors, small things, small errors. I don't know how I thought I was going to do this one on the screen. Well, we'll figure it out. Okay, so I'm just going to take the audit average divided by the book average. Okay, so I'm going to do it underneath here, I guess. Okay, so the audit average was 3780. And I need the book average. This one up. All right, so I'm going to divide these. That's going to give us a ratio. There's a ratio of what we came up with to what they came up with. And then we're going to multiply that times the total book value, which is a million. And this will give us our projected value. So we're saying everything's off by a ratio. Large items off by large amounts, small items off by small amounts. Looking at that number, I hope I did this to come up with something nice and easy. Oh, yeah. So it'd be 900,000. So this is the projected value based on the ratio. We're saying that they're off by a ratio. Large items are off by large amounts, small items are off by small amounts. This one is probably the one that's most, for most accounts, I would say is probably the most accurate or most useful, maybe is a better way to put it. Okay, and the total book value was, I'm just gonna copy that. The one thing I want to teach you guys is how to be lazy like me. Just like lazy, lazy, lazy. Oops. Let that be a lesson. Being lazy doesn't. Okay. So this is, so the projected misstatement is what, 100,000? Mhm.
Was the rationale behind the ratio method?
Yeah, it says that there, that there is a ratio of things that are off. So for instance, something that's off by a small dollar amount, or something that is a small dollar amount will be off by a small dollar amount. Something is off by some large account is more likely to be off by a larger amount. For example, a $5,000 error. If there was a $100 account, you wouldn't expect it to have a $5,000 error. Right, that's quite a bit. But a $5 error, yeah, maybe, but not a $5,000 error. So it goes by, the size of the account, size of the thing that you're testing. Now, if you have a account that's, $138,000 and it's off by 5,000, that's probably not that far out. It's probably more reasonable. So it kind of says, that if it's off by a ratio. And I'll tell you when this method is good to use, when you have fairly small accounts and fairly large accounts mixed together. If they are different sizes, it's likely that small ones are off by small amounts if they're off, large ones gonna be off by larger amounts if they're off. You wouldn't expect them to all be off by the same amount, which is actually the next one we're getting to, but yeah. So the rationale is that there's actually a ratio that it's off by small misstatements for small accounts, larger ones for larger accounts. And I can tell you that in my auditing, that's pretty much the way they've, you'll find them. Yeah. Okay, so I'm gonna put this up here. Is this an overstatement or understatement? Over, yep, an overstatement. We're saying it's 900,000, they're saying it's 1 million. Okay, now difference estimation. This one is probably I don't want to say the least useful, but the least, I would say maybe the populations don't usually fit this category very often. And that is, everything is off. If something is misstated, it's misstated by the same amount. So, a $100 account, if it's misstated, will be off by the same amount as a $50,000 account. That they'll always be off by the same amount. And so what we do is we take the book average minus the audit average and we multiply it by the total population. So let's see what that looks like. Give me a second to clean this one up. All right, so we're going to say that I'm just going to do the math here and then, so audit average minus the book average. We can actually do it over here, I guess. I got this backwards. Okay, let's try that again. This is fun, isn't it? This is fun. All right. So the book average is 42 minus the audit average. Is that $4.20? I think it's 420. Oops, not 4. I'm gonna type something. Okay, so 420 is our average that it's off by. So we're saying, so here's what we're really saying with this. Everything is off by 420. Doesn't matter what size the account is. It's off by 420. Every account is off by the same amount, $4.20. And we're going to multiply that by the total population. So everything in that population, 25,000, all 25,000 items are off by the same amount, They're all off by $4.20. Now, this is a little bit different than the other ones, and this will give us our projected misstatement. Not the projected value, the projected misstatement, so whatever that. It is 420, right? You guys are auditors, you guys should know this. 105,000. So this is the projected misstatement. Now, are we saying that everything is overstated or understated? Yeah, this is going to be an overstatement because you'll notice that the audit average is less than, I should have changed those. The audit average is less than the book average. So we're saying that these are overstated by $4.20. Every single one of them is overstated. So the projected misstatement will be 105,000. So this is kind of a strange one, is that it's, oops, copy that. Hey, link copy right. Just type it in. Those are, it's overstated. So what would the projected value be? Well, we can back into it. The total book value is $1 million. Minus the projected value, whatever that is going to equal our 105,000, positive 105,000. So what's the projected value? You can put an X in and solve for it if you want. Yeah, what'd you say, 890? So this will be our projected value, 895,000. And again, this one is, it's sort of, it's different than the ratio one in that this says everything is off by the same amount. I don't think I've ever used this one when I was auditing. I might have, but I don't think I did. And you say, well, okay, when does this ever happen? This would happen if you had like something that would, like, let's say there was a handling charge for $4.20 that it was forgot, people forgot to add those into certain invoices or something, the handling charge. So if they're off, maybe they're pretty accurate, but if they are off, they're going to be off by that $4.20 handling charge. Not everything, but maybe most things that they're off, it'll be off by that handling charge. So that's kind of what the idea is of it is that if anything's off, it's off, and whether it's a $5 account or a $50,000 account, $4.20 is what it's likely off by. I definitely use the ratio one is probably the one I use the most when I was auditing. I did use this one. I'm almost positive I used it. I can't remember exactly, but when I was at US Steel, you had all these rolls of steel, and they all had their grades to them. And if you look on the sheet and see what the cost is and all that, and you could just take an average of them, and it was pretty accurate. It was accurate within some ridiculously small number. Okay. Oh, I know what you're saying. Oh, wait. Let's go ahead and do one more, and then we'll talk about when we use them. We use them for. This is page 2. Tell you what, I'll keep my mouth shut. You guys work. Just to save space, I'm gonna take these out. Okay, so, one of the things when you take the exam, you kind of, you can memorize things, but you can also kind of just get a feel for what they are. When they say mean per unit, they mean average. And the question is, whose average is the more persuasive? Well, it's our average. So mean per unit just means our average per unit. For some reason, I have those all italicized. You can look on the, I think actually I have the calculations on the last page. They do. Yeah, they're on the last page, but also has the calculation. Okay. So the ones that we did are the more persuasive ones. Ah. So we're gonna say that everything in that population. Okay, over or understated? Understated. We're saying they should have 8,295,000. They only have 8 million. So they are understating. Where are the accounts receivable? So understating it. Why would they understate accounts receivable? Kind of a strange thing to underestimate. Why would they do that? I mean, it's an asset, comes off of sales. So why would they understate that? When do you want to look less profitable? When you are paying taxes. Yeah, and you know, there's the beauty of understating your revenues, because not only do you not, you know, does that not, it decreases your income tax, but also if you have sales tax and things like that, it postpones you paying those, so. But they have people that come out and revenue auditors. I'm sure you're counting it all. Large companies, you generally don't need to worry about that as much, but small companies, certainly you do. Large companies get audited every year, pretty much by IRS. Okay, ratio estimation. So we said there's a ratio of audit to book. And you're not unsure whether, you know, what goes on top. This is kind of strange. In auditing, and actually in almost everything in accounting, it's alphabetical. Audit over books. I often thought if I wrote a book, I'll say, yeah, it's alphabetical, you know, because almost everything that you do that's a ratio in accounting is. So we go to ratio. Yeah. So we're going to do the ratio. In other words, big things are up by big amounts, small things are up by small amounts, and that everything in the population is like that. I'm sorry, the total book value. So this will be our projected value. And so we want to see, so it's overstated or understated, it would be. Understated. We're saying that they should have 8,400,000. We only have 8 million, so we're saying it's understated by 400,000. And again, whether that's material or not, the judgment call, but we shall get the same 400,000. And the wackiest one, it's estimation, which means that everything is off by the same amount. Wait a minute, book average minus. So this is gonna be, oh, these are understated. So $3.95 is, each one is misstated by $3.95. Doesn't matter how big or small it is. And we'll multiply that by the total number of items in the population. 100,000. So all $100,000 items in the population. So 395,000. And so you do notice that these are getting, ooh, too many. These are giving us different numbers. So obviously it makes a difference which one we choose. Value is 8 million. Projected value, don't know yet. Projected misstatement, we do know is 395,000. No, it's an understatement. So the projected value must be what? Yep. Did this wrong. Let me try that again. Rather than do that, let me put what you actually said up on the board, and that'll be our projected value. And again, 395,000, whether that's material or not, is a judgment call. Okay, so the question is, which one do you actually use? And you'll get different answers for each one. It might just be dumb lucky you get the same one, but you get to different answers, and you look at this first one, it could be off by 55,000 or as much as 105,000. So it makes a difference which one you choose. And it depends on the population. So, big old, okay, mean per unit estimation is used when. Finding the same value, or when the or when the book value is unknown. If there's if the controls are such that you really don't even know what they are, what the book value should be. Well, if you don't know what the book value is, you can't. There's no way you can get the average book value if you don't know if you're not don't have enough confidence in it that you can actually get that item. Um, they may have a number there that you have no confidence in. This is the only one you can use. And again, this is like ducks on the pond. How much are they? How much do they weigh? Okay, ratio estimation. This one's probably the most. let's break when items are most likely misstated relative to size. Um, Large items have large misstatements, smaller items have smaller misstatements. It's also useful when you have a large discrepancy between this ratio estimation the population varies in size. And they vary widely in value. So that if something is, you get $5 accounts and $50,000 accounts all mixed together. It's a good one to use for that. It's not, that you would not want to use the mean per unit one for that. And the difference estimation one means that everything's up by the same amount, which, generally speaking, is probably not the way things go. But anyway, so ratio estimation is appropriate when it's likely they're misstated by a ratio. In other words, that large things are off by large amounts, small things off by small amounts. Or when you have a population that is widely varied. You can't use the mean per unit, and it might be that they're not off by the same amount, so that would be the one you're with. This is one I used almost all the time. Except only when I was a US Steel, we used it for and that's just because they're commodities, and you go by commodity pricing, and so using an average for all of them is appropriate. You have to look them up. Okay, difference estimation is appropriate when items are likely off by the same amounts, or likely misstated by the same amounts. For example, a handling charge. Handling charge is it's omitted, or sometimes there, sometimes not. You have handling charges for certain things that don't always get applied. And these are just the formulas. Anyway, so I'm just going to send you that exam. Let's have one of each of those. It probably take, I don't know, 15, 20 minutes maybe. Maybe not even that. Now, on the CPA exam, they don't make a distinction over which one is better than the other. What they might do is give you a scenario of what the population is like. And, if they're all about the same value, mean per unit's fine. If they're all different values, or if they're all likely off by a ratio, then the ratio estimation. Audit over book, A over B. Or if they say carry value, A over C. And difference estimation when everything is off by about the same amount. Usually if there's a missing charge or something like that, it wouldn't be anything like taxes because that's usually variable. Okay, that's it for that one. You're kidding, it's 653? Man, I took too long on that. Sorry, guys. All right, well, next thing we'll do, I'll do this when we come back. We'll do the final case. That one will take that long. I do want to get it started on that one. So let's say be back at, what is it, 7:03? And I'll leave up the, leave these up if you want to take pictures of it or screenshots of it. All right, final case. And this is kind of a, hopefully again gives you the feel of what. Okay, so. It comes out of chapter 10. Should be a period. So in October, Janssen Talbert, the CPA firm, was retained by Moonglow House to perform a year-end audit. A month later, Tom Holden, president of the corporation, invited them to the CPA firm's partners to attend a meeting of all the officers of the corporation. Mr. Holden opened the meeting with the following statements. Okay, so first of all, is there anything wrong with having the auditors at a like a board meeting or something, or a high-level meeting? Nope, happens all the time. They will, oftentimes, you know, if you board meeting, you'll see a couple of people dressed very nicely, playing with their phones. Those are auditors. And the idea is that, you know, whatever they're going to ask for the minutes in that anyway. So oftentimes they'll say something and then ask, any input on this, and they'll shake their heads and whatever. Okay. As you know, we are not in a very liquid position. What does that mean? No cash. We need to raise some outside capital. Need to get some cash. In January, in our December 31st financial statements, balance sheet and income statement must look reasonably good if we're going to make this favorable impression upon lenders and investors. I want every officer of this company to do everything possible during the next month to ensure that at December 31st, our financial statements look as good as possible, especially our current position and earnings. Okay, is there anything wrong with that statement? Actually, there's not. Companies all do this. They try to make themselves look good, and they don't just do it because they're incredibly evil. What they are doing it for is it actually has an impact on how well the place is run. The better you make yourself look, the less interest expense you pay or whatever you pay to dividends payout, and you know that it makes sense to try to make yourself look as good as possible. And there are things, that are legally that you can do to do that. Okay. We've invited our auditors to attend this meeting so that they understand the reason for some of these year-end transactions that might be a little unusual. In essence, our financial statements carry the auditor's approval, or we'll never be able to make get the financing we need. Now, what do you have? So here's what you're going to do. For this case, for each one of these, I think there's 10 items. Each one of these 10 items, you're going to do a little write-up. We'll talk about in a little bit here, of whether they can do this or not. And they're just asking, what do you think? Basically. So the vice president said that we can talk to some of our large customers and placing orders early. And it will increase this year's earnings and increase our current assets. Okay, probably accounts receivable they're talking about. Vice President in charge of production says we can ship every order we have during October, during December, and close the books January 31st. Have to pay overtime in the shipping department, but we'll try not to have a single unshipped order on hand. So that's another one to look at. Also, we could overship orders. And the customers won't make returns until January. So it's actually a common practice. It's not as much anymore because they actually have accounting rules to stop it. But you know what that's called? Overshipping orders at year end. It's called channel stuffing. It used to be a common thing. They actually have rules in place now that if they do that, if they have a large number of returns, they have to put it on their financial statement at year end. You have to reduce the sales by it. So there's no benefit to doing that now. The controller said at late orders the customer that we actually ship, we can just label the merchandise as sold and bill the customers with December 31st invoices. Okay, so label them as sold, stick them aside. Also, there are some checks the customers dated December 31st that don't reach us until January, as late as January 10th. We can record all those customers' checks bearing the dates of December as our December 31st cash balance. Treasurer offered the following suggestions. I owe the company $50,000 on a call note to buy some stock. I can borrow $50,000 from my mother-in-law around about Christmas time, but I'll have to borrow money from the company again in early January because the mother-in-law is buying an apartment building and will need the $50,000 back. Okay, this might sound like a really weird one. This is one of the reasons that Sarbanes-Oxley came about. It used to be a very common practice in business to align the management's goals with the stockholder goals. You know, in the past they would say, okay, they give incentives, stock appreciation rights or stock options or something like that. The problem with those is that there was no negative. The company did really badly, nothing bad happened to management. So what they started doing, instead of giving them stock appreciation rights or stock options or whatever, what they would give them are loans that they could only use to buy company stock. Now, if the stock price decreased, notice that what they bought, they have a loan that's bigger than what the asset's worth. So it kind of put them on the hook. This got stopped by Sarbanes-Oxley because management started doing really terrible things to make sure that the stock price didn't fall because they had these loans on their books and they had these loans. So companies loaning money to officers to buy their own stock was not that uncommon back then. Now it's pretty much prohibited at least for publicly traded companies. Number 7, another we can do is prove our current ratio is to write checks on December 31st to pay most of our current liabilities. Okay, this one, believe it or not, is actually something that, maybe I should do this on, instead of doing it on the board, which no one will be able to see, I'm going to do it I'll do it in Excel. Yeah. Okay, here's what they're talking about here. So let's say we have these current assets. You have to write this down. Let's say that we have cash. Oops. What? Not cooperating. We have cash of 12,000. Let's say we have inventory of 28,000. Okay, so these are the current assets. And let's say we have current liabilities that look like this. Accounts payable. 20,000. Oops. Okay. So the question is, what's our current ratio? Yeah, it's gonna be current assets with this. We have 40,000 of current assets, so it's current assets over current liabilities. Okay, so it's gonna look like this, 40,000 divided by 20,000. And that is going to equal. Oops. Wait, I messed this one up. I'll just put it right in here. You only get 2, right? Okay, so this will be our current ratio.
Sir, you put the inventory at the liquid assets, and usually it's not that much liquid.
They say current assets or where am I? They say current ratio. Yeah, the current ratio will have all of them. But yeah, some of the like a quick ratio or acid test ratio will only have the financial assets in it. Okay, let's say that we take some of our cash. Let's say we take 10,000 of our cash and pay off 10,000 of our liabilities. Copy this. So I'm going to pay off 10,000 of our liabilities. Now, is there anything wrong with paying off your liabilities, paying them off early? Not really. Okay, so your cash is not going to be 12,000, it's going to be what, 2,000? And your accounts payable, oh, I think copy those down. And that 20,000, there'll be 10,000. So this will be 30,000 divided by 10,000. So now our current ratio just jumped up from 2 to 3. Now, actually, we have less cash, but our current ratio is better. And you might say, well, you shouldn't have paid out those early, right? You shouldn't, it's bad management paying that off early. Not necessarily. This might get you a much, either get you a loan you wouldn't get or get you a better interest rate. So even though, theoretically, maybe it makes a company more vulnerable or less, less liquid position, it might also, in the end, either get them the loan or get them a better interest rate on it. So this is kind of window dressing, and this is one of those things that is fine. A lot of companies do stuff like this at year end. There's nothing wrong with paying off your accounts payable early. But anyway, so that's what they're kind of talking about there. Okay. So that's number 7. Number 8. We might even wait to mail the checks for a few days or mail them to the wrong addresses. That will give time for January cash receipts to cover our December 31st checks. Nine, the Vice President of Production made two final suggestions. Some of our inventory we had tentatively identified as obsolete does not represent an open check case as being unsaleable. We can defer the write-down. Another item is some machinery that we have ordered for delivery in December. We could instruct the manufacturer not to ship the machines and not bill until January. Okay, so apparently if they're not going to use those machines in December, I assume is what they're talking about here, that they could delay it. You can see we're doing our best to give you full cooperation. Many suggested action prevent you from giving a clean bill of health or statement. I want you to know, I want to know about it so we can avoid anything that would keep you from issuing an unmodified audit. I know you'll be doing a lot of work, blah, 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 blah. Oh, but I'd like for you not to bill us before January. You please give us your reaction to what it said. Okay. Now the file must be typed in Word. Okay, yeah, Word format. Take this out. Scan or PDF files will not be. You can turn them in PDFs. Take that out. Cross it out. I'll take PDFs. So if you do it in Apple or something like that, to save it as a PDF, that's fine. Okay. Put yourself in the role of Gans and Talbot and evaluate separately each of the 10 suggestions. Some of them are acceptable, some are not. Also remember, Moonglow is a client. Use professional tone. Do not accuse them of fraud. Actually, you should never accuse anyone of fraud. Did I talk about this? If you're an auditor, one of the things that some auditors stupidly do is they'll find someone committing some kind of a fraud or something, and they'll put it right in a report saying so and so is committing fraud. And then they get sued and they lose. Because fraud is a crime, and unless they've been convicted of a crime in a court, you really don't have anything to stand on. So you never, even if you do find someone doing something wrong, they haven't done anything here yet. But even if you do find someone committing a fraud, you never accuse them of that. What you simply do is put the situation in the, such and such money was missing from whatever. You never accuse somebody of it. And people say, well, they take me to court, I'll prove that they did it in court. Fraud is a criminal case. You can make a fraud. And, if they sue you, it's going to be a civil case. And you can't get a criminal conviction in a civil court. Okay. You hear sometimes, this guy was embezzling money from the company and he turned around to sue the company and he won. Yeah, they probably accused him of crimes he wasn't convicted of. Okay. It's not an ethics case. Okay, some of these things are kind of wacky here. I've been in meetings where someone said, no, that's unethical, and someone said, well, can we do it? But it's not an ethics case, so don't make a kind of a judgment on ethics about it. And they're whatever. This is not a research case either. Actually, if you get 6 out of the 10 correct, you'll get 100% for the content. So you don't need to research these. Most people can do them off the top of their head and get at least 6 out of the 10 right. I don't know if people that for this case, I don't know people that have actually answered all 10 of them that have ever not gotten at least 6 out of 10. I've had people answer 5 of them and not get the 6 out of 10, but I've never had anyone who answered all of them not get it. Okay, we can talk a little bit about this. What characteristics of Moonglow as a client are reassuring? There's something very good about this client, actually. What is it? Besides that they offer funny suggestions sometimes. I was in a meeting one time and a guy kept suggesting that we don't record we have deferred tax assets and liability. We have a bunch of deferred tax liabilities. He says, well, they never get paid because every year we have them because, we would buy in inventory or equipment and stuff. Well, why do we have those? They never get paid. We shouldn't have them. There's no reason to put those on. But yeah, there is. We go to jail. So, well, what's reassuring about Moonglow? If you're an auditor, remember you think about integrity is probably the most important thing in a client. The ICP will tell you that, it's integrity of the client. Hey, what is good about this client? Anyone? Anyone watching at home? No? Yeah, I bet you at home you guys are watching like cats play the piano on YouTube or something. Anyone?
So I think this gives full information. It wants to avoid the proper action.
They're right up front. They're telling you remember, this is not something you found. You didn't find them, mailing stuff to the wrong address or whatever. This isn't something that you came across. They're telling you. They haven't done it yet, but they're telling you, they're completely upfront and honest about everything they're doing. So that is, keep that in mind that these are not things that you found. These are not, once you started the audit, oh man, look at this. They're telling you right up front, and that is a big, a good thing for, a lot of places wouldn't do this. Well, just do this. The auditors won't find it, or hopefully they won't find it, or whatever. Can auditors indicate what transactions would be meant in unmodified opinion? That one's probably a no. You can't say, yeah, well, if you do this, this, and this, and you don't want to say which ones that they don't need to do, certainly. So, can they indicate you can only base your opinion on the audit evidence. That's it. You can't base it on conjecture or promises or anything like that. So the only thing you can base your opinion on is the evidence. What is the evidence? You have to get enough good evidence. You have to get sufficient appropriate evidence to make an opinion, and that's the only thing you can base your audit opinion on. Now, dealing the billing of the auditors, this one is a little bit this one's a little bit you're wondering a little bit what they're actually talking about. Delay the billing of the audit. First of all, the audit as an expense, would it matter whether they bill them or not?
I think under the appropriate accounting cannot the billing can be scheduled later, but the auditors cannot delay the reporting expenses.
That's exactly right. Yeah. So I think, it depends on what they're asking here. If they're asking that they don't have to include the audit expense as part of their financial statements, then no, absolutely not. They will have it on the books. If they're asking about delaying the actual payment of it, that's something a little bit different. But you still gotta be careful, because what you run into here that could be a problem is that you would not be independent. So let's say they say, okay, we're going to record the expense, but we just can't pay you until January. All of a sudden now, as an auditor, you have an investment in this client, Because if they don't get this loan, you might not get paid. Even if that isn't really the case, that you're not worried about getting paid, you get paid at some point, whatever. It's gotta be, you gotta be independent in both, fact and appearance. And it might have the appearance that, well, no, they just gave them a clean audit report because they need to get their money and they need to get, so they can get financing and get paid for it. So you also have this additional problem of if you don't get paid, an independence issue can be part of the problem. It really depends on how big or how much money they're talking about, but you got to be very careful about stuff like that. That if you cannot have a client owe you a lot of money because at that point you're no longer independent, and if you're not independent, you can't do the audit. Okay, any questions on this thing? Now, these do not have to be as far as whether they can do it or not. These are not, these are one or two sentences each. You don't have to give, 3 paragraphs on, writing down inventory. And I don't want that. They want to know, can they do it or not? And you probably don't want to cite, AICPA code. It's probably, you can tell by here, it's probably not gonna make any, they obviously are not really into reading the AICPA code on any of this stuff. So just tell them whether they can or not, and the reason why. You can't do this or that or the other thing. And so it's not really a research case. And if they say if you get 6 out of 10, never had anyone knock at 6 out of 10 that answered all 10, you should be fine. And you're just going to tell them 1 or 2 sentences at most for these. Again, don't put paragraphs in here or anything like that. So they want to know, and the tone of it, the letter going out, the tone of it is important. You're not chastising them, you're not telling them they're doing things illegal or anything like that. They haven't done anything yet. So, and they're a client, and presumably they're a client you want to keep, or you want to be there. All right. Okay, so that is due the end of class. By the end of class, that is due on the, did I say 12th? I think it's the 12th, the last class. All right.
Professor, must we submit this on Blackboard?
I'm sorry?
Are we submitting this on Blackboard?
You saw it on Blackboard?
No, you said it's due on the 12th.
Yeah.
Are we submitting it on Blackboard?
Yes, yes. I should check and make sure. I think it's in there. Let me
Yeah,
check. It's in there? Okay. Yeah. Just submit it in Blackboard. Well, if you come to class, you can say, if you want to bring it next week, like a week 15 or whatever, or week 7. Yeah, that's another possibility too. Okay, so yeah, that's that. I think we got a little more time. I think we'll get started on the chapters. If there are no questions no more questions on it. And again, this isn't going to be a really long paper. There's 10 questions in there. You can cut and paste and then put your answer underneath there. And again, 1 or 2 sentences should do it for each one of those. Again, tone is important. Don't say they're criminals or idiots or anything like that. And some of these things are good, some of them are not so good. Okay. Let's go to, we're not going to finish this one, I don't think. Completing the audit. I think we'll just do the analytical procedures and then we'll call it a night. So chapter 16, analytical procedures. Analytical procedures are, did I talk about these? I can't remember. Analytical procedures are, a lot of it are things like looking at ratios and that. Analytical procedures are looking for plausible relationships between numbers. Plausible relationships between either financial data or non-financial data. The data might be financial. Or non-financial. Let me clean this up. I don't like non-financial. Oh, I have a hyphen there. Okay, so what's the relationship between the financial statements and data, the data be financial and non-financial? So you're looking for relationships between numbers, things that you would expect. And these analytical procedures, they are required at the beginning and at the ending of audits. Let me write that. They're required because about 90 some, depending on what you really look at, 90+% of fraud is discovered through analytical procedures. So they're required at the beginning and ending of the audit. Oops. And for good reason. Again, something like 90+, but some places say 90%, some say 95, some places 98, whatever. A large part of the fraud is discovered through analytical procedures. And it has to do with the double entry systems, a lot of it. If you say that you made these sales and you put them in accounts receivable, well, at some point, cash has to come in. If you make up accounts receivable that are fictitious, well, those are never going to get paid. The cash is never going to come in. Right? So, the fact that we have this double entry system kind of makes it somewhat difficult for places to have fraud, and it's not something you can clumsily do to get fraud past an auditor because it's all connected. Okay. So let's take a look at these unadjusted account balances at the beginning of, I gotta update this, 2023. Okay. So we have sales in 2022, 2023. Cost of goods sold, that's the cost of the items that we sold to people. And then we have selling expenses. And the initial risk assessment identified the increase of cost of goods sold as an area of interest. Okay, does this make sense? You're selling more items. Scratch that. You're selling less items in 2023, but your cost of goods sold is higher. Now, is that evidence of fraud? Do you call the police after that? No, but you're going to investigate it, right? Say, okay, that's kind of strange that their sales went down, but their cost of goods sold went up. That's kind of unusual. And notice that the selling expenses actually went down, which would kind of coincide with sales going down. Maybe they advertised less, or the commissions were less, or whatever it was. So the outlier here, all three of these accounts should kind of go together, but they're not. And this kind of cost of goods sold was the outlier, so that's one we kind of focused on. Okay, so we go to the end of the audit. Determined the cost of goods sold was not materially misstated. However, the sales were materially misstated and should have been 1,200,000. Okay. So the adjusted balance. So we, obviously tell the client says, oh, okay, well, we'll change the sales to whatever, whatever reason they had for doing it. Well, now these kind of look a little more plausible, right? I mean, if the sales are 1.2 million, you would expect the cost of goods sold to go up. And, you know, when we investigated cost of goods sold, that wasn't materially misstated. So we turned to the sales, and sure enough, the sales are misstated. After the adjustment, now what accounts look strange? Yeah. So one of the reasons we do this at the end of the audit, we say, okay, after you make all the adjustments, you know, so we tell them about it, they make the adjustment. We go over it again because now it might indicate that there are some other problems once these get, you know, sorted out. There might be other. So after the adjustment, which comes from the selling expense, you know, sales went up, you'd expect that selling expense would go up too. You know, either you advertise more or you pay more in commissions or whatever it is. Now, again, it might just be that, you know, that's just the way it is. There's nothing wrong with it, but you might want to investigate the selling expenses, see if the selling expenses were. Okay. So those are the procedures. And let's stop here. So next week, we'll get this won't take long to get through this one, and then we'll do some of the reporting. We're actually writing up, you know, how do you actually write up the opinions, and that'll be it for the class. Not next week. I said that wrong. Yeah, week 7. Your week 7, my week 15. Not that one. Here we go. So we will finish this up on the 4th. So 12/4, we'll finish this up. Okay. Any questions? All right, let's check in. I'll say adios to those of you online. I'll stop sharing first. I don't like sharing anyway. All right. Good night.